If you own an S corporation, this can happen to you. No warning, no email, no obvious mistake. You keep running your business. You keep filing your taxes. Everything looks normal. And then one day, you realize your S Corp election was already terminated. Not recently, but sometime in the past, without you noticing.
How would you not know that?
Because the issue doesn't begin at filing. It begins earlier, in ownership decisions that don't feel like tax decisions at all. Termination is triggered by structure, not by the act of filing. This applies if you have an S corporation, a trust, or any ownership change. Because most failures don't come from clear mistakes. They come from routine events, estate transfers, ownership updates, internal restructuring.
So this is just normal business activity?
Exactly. And that's why it's missed. There's no signal that something broke. Risk increases when actions feel routine. This company operated normally. They filed Form 1120-S each year. No IRS notices. No irregularities. Revenue was consistent. Operations were stable. From a compliance standpoint, everything appeared intact.
So nothing pointed to a problem?
Correct. Because the issue was not in the reporting. It was embedded in ownership. Accurate filing cannot fix an invalid structure. Then a shareholder passed away. The shares transferred into a trust. From a legal standpoint, this is expected. From a planning standpoint, it is often intentional. But for S corporations, ownership is not neutral. Every shareholder must meet eligibility rules.
So the transfer itself triggers review?
Yes, every ownership change creates a new compliance test. Eligibility is evaluated at the ownership level. The tax code allows a temporary transition period. Certain trusts can hold S Corp shares for a limited time after a shareholder's death. So initially, the structure still qualifies. But this is not permanent. It is a defined window to transition into a compliant structure. Once that period ends, full compliance is required. Time is provided, but not indefinite flexibility. The shares were then transferred into a new trust. Operationally, this is a continuation of estate structuring. But from a tax perspective, this is a new owner. And that resets the eligibility analysis.
So each new holder is evaluated independently?
Exactly. The IRS does not rely on prior status. Eligibility does not carry forward. It must be reestablished. This trust was intended to be a QSST, a qualified subchapter S trust. QSSTs can qualify as S Corp shareholders. But qualification is not automatic. It requires specific conditions to be met. One of those conditions is the beneficiary must file a QSST election.
So the structure alone is not enough?
Correct. Without the election, the IRS does not recognize the trust as eligible. Compliance is based on elections, not intent. In this case, the election was not filed. As a result, the trust did not qualify as an eligible shareholder. Under S corporation rules, that creates a direct consequence. The presence of an ineligible shareholder automatically terminates the S Corp election.
So there's no warning?
No. The rule applies immediately when eligibility fails. Eligibility is binary, either valid or not. The key timing point is this. The termination occurs at the moment the shareholder becomes ineligible. Not when discovered. Not when reported. At the ownership event itself. The tax return only reflects what has already happened. Reporting follows structure. It does not define it. Consider the impact. A business generating $300,000 of income under S Corp treatment, that income flows through once. Under C Corp treatment, it is taxed at the corporate level and again when distributed. The activity did not change. Only the classification changed. Tax outcomes follow structure, not effort. This issue is often missed because attention is placed on income reporting and tax filings. But eligibility is determined by ownership structure. And ownership changes are not always tracked through a tax lens. Visibility is highest in reporting, but risk lives in structure. So the real questions are, has ownership changed? Is every shareholder eligible? Were required elections filed? If any of those are unclear, there is risk. An S corporation is not a one-time setup. It is an ongoing qualification.
So the risk isn't complexity, it's missing a requirement?
Exactly. Compliance is not about intention, it's about meeting every requirement. Subscribe to IV Smart Tax to understand how the IRS actually evaluates these structures before mistakes turn into consequences.